Okay, so let's explore horizontal analysis, vertical analysis, and ratio analysis. Now, we're going to approach this with a very simple financial statement. We'll have sales less cost of goods sold equals gross margin less operating expenses equal operating income. Okay, very simple income statement. We're not including many other lines just to illustrate how this works. Okay, so with horizontal analysis, what we typically do is we have columns for one time period versus another. There can be exceptions here. And then we compute an increase in dollars in the change. All right, so if I eliminate this now, I have an example. So last year we had sales of, and let's assume this is thousands, right? We'll make this in thousands. Okay, so last year we had 10.1 million. This year we have 10.5 million. That's an increase of 400. How do we calculate that? Just calculate the difference. Take the current year minus the prior year for a positive change. Okay, and if by chance it went down, the number will show up as a decrease. Now, once we have that, we have to compute the percentage change. And the way you do that is you simply take the change divided by the base year, the earlier period. Okay, and then we just copy that and do it the same way. Now, what does this, what does this provide? Well, it lets us see how we changed by line item year over year. And you can do this for the income statement, cash flow statement, the balance sheet, even a statement of retained earnings. Okay, in my experience, it's always the income statement where this gets used the most. That's horizontal analysis. Now, what we covered was really just the science of it, how to put it together. Where the art form comes in is up to you as the analyst. You're looking at the data and you need to evaluate what's happening. For instance, in this example, you can say sales went up 4%, but operating income went up 11.1%. You might need to investigate why. Well, we see sales went up 4%. Cost of goods sold went up less than 4%. Therefore, it drove up gross margin because sales increased at a faster rate than cost did. And since sales less cost gives us a margin, the margin would increase even more than the increase in sales. Okay, and then we see, well, operating expenses went up faster than sales, so that maybe is not such a good thing. All right, it's just something to keep in mind. All right. That's my example of horizontal analysis. Next, let's talk about vertical analysis. All right, now I've moved to a different tab on this spreadsheet, and here we've got an example of vertical analysis. So here's our company, and with vertical analysis, and again, I'm using that same simple financial statement, you put the income statement and then going down in dollars, and then you create a column for percentage. Okay, and then you have to choose an item as the base. In the case of an income statement, the base is net sales. So we divide every dollar amount by net sales, right? So if you can see here, the value we're getting in cell D7 is the percentage of cost of goods sold would be the 9,100. Again, if this is in thousands, that's 9.1 million divided by 10.5 million. All right. So that, this 4.8% is the 500,000 of operating income divided by 10.5 million of net sales. Okay. And now this then gives us some idea of what our yields are per sales. So we could look at this simply and say, oh, for every dollar of sales, we're generating 4.8 cents of operating income. Okay, see how that works? For every dollar of sales, we're generating a gross margin of 13.3 cents. Okay, now you could compare it to your same company in a different year, but that's not usually how this, in my experience, that's not how I've seen this used. When we're talking about vertical analysis, we're more likely to compare it to a different company, maybe an industry average, or perhaps this might be actual I can spell it right. I still can't spell it right. Actual. And this might be, let's say, budget. Now, of course, my numbers are way off here because I based it on something else. But you get the picture. You can compare something to something else. Okay? And by the way, actual versus budget, in my experience, tends to use horizontal analysis more than vertical analysis. Let me put this back to some other companies. This is typically how I've seen this used, where we compare to an industry, the best company, or maybe an industry average. Now, it's vertical analysis, also called common size financial statements, for precisely this reason. You can compare your small company of 10.5 million to some mammoth company of 5.1 billion, and you still can get some sense. Again, this is now, so far what I've shown you is just the science. The art form is the analysis you use to uncover knowledge from the data. So in this instance, we're saying, hey, we're earning 4.8 cents for every dollar of sales. We're a little bit better than Procter & Gamble. Well, why is that? And we begin to see, well, for some reason, our cost as a percentage of sales is less than the overall industry. Now, maybe we have a high product, a high quality product, or maybe our customers love us and we're able to sell our products at a higher price. Or maybe we've got some reason that our costs are lower. That's where your analysis needs to come in. Okay, but this is an example of how you would work with vertical analysis. A couple other things. By the way, this number here is actually one of the ratios. I'll talk about ratios in a minute. Financial ratio just means one number divided by another. And this would be a profitability ratio, right? An operating income divided by net sales. We'll go over some of these in a little bit. Okay, so now let's talk about ratios. And I'm back on the original worksheet page we started on. There are 4 categories of ratios. You can see it right above my mouse here, okay? Liquidity ratios include the current ratio and the quick ratio. These are measures of our ability to pay short-term obligations as they become due. Then we also have solvency ratios. Solvency ratios, I think of them as flip side of the same coin. It's not exactly liquidity, but it does measure our long-term ability to meet our financial obligations. So here we're comparing our level of debt to our level of equity, or perhaps our level of debt to total assets, and these are considered solvency ratios. The third category would be activity ratios. Examples of these would be days sales outstanding. How many days does accounts receivable remain on the books before we collect it? That's what days sales outstanding tells us. Or inventory turnover. How many times during the year does inventory turn over? Activity ratios are typically a measure of operating or financial efficiency. Okay, and then we have profitability ratios, and these most likely have the word return in them. Return on net sales, we're looking at net income versus net sales. Return on assets, we're looking at net income versus assets. Though some companies, you may be using operating income as in lieu of net income. Or return on investments would be, net income divided by the investment, and the investment probably would be shareholders' equity. Sometimes it can be something else like assets employed, which is total assets minus current liabilities, which is sort of a modified version of return on investment. Okay, so we've got these 4 different categories. One thing to remember, if a ratio has an average, like you have to measure something by average owner's equity. The most simplest way to calculate that is you take the beginning balance of whatever you're using. If this was average owner's equity, you take the beginning balance of owner's equity and add the ending. Now, I've had some students say, well, I don't know what the beginning balance is. All right, the beginning balance is exactly the same as the ending balance from the prior period. So if you're giving 2 years, let's say 2025 and 2026, okay, the beginning balance would be the ending 2025, the ending balance would be the ending 2026, and you could calculate the average for year 2026. Okay, and here's my little example. Let me slide down so it's not on the bottom of your screen here. Return on assets, net income over average assets. So average assets, you take the beginning plus the ending divided by 2. All right, now, having said that, okay, having said all of this, particularly with regard to ratios, I have lots of examples in other videos of ratios, so I'm not going to go into this here. However, if you'd like me to work through all the ratios, and there's many of them, I would go to YouTube and search for, I'll type this in, Fed's ratio examples. You can certainly search for, go to YouTube and search for Ed Kaplan financial ratios, but there's one in particular I'm going to point out. Search for Ed Kaplan. Look for ratio, Jack Frost. Okay, if you search for that, you will, I think there's a 16-minute video I've put together where I cover how to calculate a number of different ratios. Now, one thing to keep in mind, different textbooks have slightly different definitions of the ratios. So you want to focus on whichever textbook you're using. It's probably not critical that one ratio is different from another, so long as you, as an analyst or a company, uses the definition consistently, right? So that you don't get some kind of improper result. So I think differences in ratios is okay. Just use it consistently over time. Okay, so this has been a brief introduction to horizontal analysis, vertical analysis, and ratio analysis. These are the 3 primary tools of financial analysis used by accountants and financial professionals. Remember that these are starting points. Real art form is what do these tools reveal? And then how do you go investigate from there to glean some knowledge from the information that you've analyzed?